So let's talk about buy what you know. I'm so curious these days how you're thinking about the economy.
Well, I think people that are investing in individual stocks, it's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher?
People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money.
The book, One Up on Wall Street by Peter Lynch. It is a fantastic resource for new investors who want to understand stocks and what it's like to be a shareholder. One valuable approach Lynch introduced for navigating the stock market is stock categorization, which involves grouping stocks into 6 different categories, each representing different levels of risk and potential rewards. He believes these categories can be practical guidelines to help investors make well-informed decisions about stocks worth investing in. And these 6 categories are what I'll be discussing in today's video. So please, give this video a thumbs up and let's get into it. Number 1. Fast growers.
The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money.
Fast growers are small and aggressive companies with an impressive growth rate of about 20 to 25% yearly. Surprisingly, they don't have to be in fast-growing industries. Some also emerge from slower growing sectors. This is Lynch's favorite category. His portfolio mainly consisted of fast growers. He's always sought fast-growing companies' stocks with strong financial health and good profitability. He believes including a true fast grower in your portfolio can significantly boost your returns. For instance, if you had invested in Google when it went public in 2004, your investment would have grown almost 50 times. However, finding genuine fast growers can be tricky. They often appear overpriced based on past measures because people pay more for their growth potential. Also, distinguishing the real fast growers from less promising options can be challenging. But due to their high risk, high reward nature, Lynch suggests having only a limited number of these stocks in your portfolio. He suggests managing your exposure to fast growers to reduce potential impacts if some of them turn out to be losers rather than winners. Remember, identifying fast growers often becomes clear only with hindsight, and it might take many years for their potential to become evident. While owning fast growers can be exciting, monitoring them closely is crucial because they are vulnerable to minor setbacks. Unlike fast growers, Peter Lynch is not too fond of the next category, which is number 2, slow growers.
So sometimes, even if a company has a very low growth rate in earnings, if the stock is selling at the right price, it may still be a very good deal. A slow to moderate grower will have earnings growth of 3 to 15% a year.
Slow growers are typically big companies in the later stage of their growth. They tend to increase their size at a rate similar to or slightly better than the country's overall economic growth. These companies began as fast-growing ones, but eventually transitioned into the slow growth category due to industry slowdowns or limited opportunities for further expansion. They operate in saturated markets where substantial investment opportunities are scarce. These companies have steadier stock prices than smaller, fast-growing companies, which can be reassuring during tough times. This makes them appealing to investors who prefer regular income from their investments. Despite this advantage, Peter Lynch wasn't particularly interested in focusing on these companies, and only a small part of his portfolio was allocated to them. Lynch believes the only reason to invest in these stocks is their decent dividends, usually ranging from 2 to 4%. A good example is GlaxoSmithKline Pharma, whose earnings have grown by an average of 2.3% each year. And over the last 5 years, it has typically paid about 90% of its earnings as dividends. Even so, Lynch suggests removing slow growers from your investments, as they don't add much value to your overall portfolio performance. Number 3. The stalwarts. Stalwarts are usually big, well-established companies with higher growth potential than slow growers. They are strong and keep doing well, even in industries with a lot of competition and older businesses. These companies don't lose value, even when the economy is not doing great. Additionally, stalwarts frequently distribute reliable dividends to their investors, and because they are big and stable, they are safer to invest in. Coca-Cola is an excellent example of a stalwart. Despite operating in the competitive packaged food and beverage industry, it has made double-digit profits from its investments for the last 20 years. The company's economic strength stems from its universally recognized brand and widespread distribution. Lynch explains that many fast growers eventually become stalwarts. Starbucks is another good example. It experienced rapid growth, over 20% in the 1990s and early 2000s, and then its growth slowed to about 10% for most of the past decade. According to Lynch's approach, stalwarts should have a permanent spot in your investment portfolio. He further advises that you should buy and hold when you identify a reasonably priced stalwart. In other words, you should own them, not trade them. Why? Because stalwarts usually maintain their value even when the economy is doing poorly and other stocks are falling. However, it's important to note that while stalwarts are relatively low maintenance, they are not entirely self-sustaining. Therefore, you must regularly monitor your stalwart holdings to ensure they perform well and contribute positively to your portfolio. And since stalwarts can sometimes change and grow slower, consistent monitoring can help safeguard your investments and optimize their long-term potential. Number 4. The turnarounds.
The turnaround, you had plenty of time. So just don't buy on the hope. Wait for the reality. Turnarounds are so big, it's worth waiting to get some real evidence.
These companies were once favorites, but had faced tough times and fallen from grace. People invest in them because they hope to buy when the company's value is at its lowest and make money when it gets better. Take Chipotle Mexican Grill, for example. The food chain underwent a remarkable transformation when Brian Niccol became its CEO in 2018. Before he took over, the company struggled with food safety issues that had severely hurt its reputation. Leveraging his experience as the former CEO of Taco Bell, Niccol implemented numerous changes. He introduced a new marketing strategy, emphasized online sales, and expanded the menu offerings. Thanks to his leadership, Chipotle regained customer trust and saw its stock price quadruple over the next 5 years, reflecting a highly successful corporate turnaround. Even though turnarounds can bring big profits, Lynch advises against investing in them because they often don't work well. He states that investors who succeed with turnarounds usually do so by getting actively involved, which includes asking for new management or seats on the company's board in return for their investment. This allows them to control how the company is managed. However, for an ordinary investor like yourself, Lynch believes attaining this level of influence is unlikely. In fact, he compares investing in turnarounds to gambling. He suggests you should avoid them if you prefer a more passive investment approach. Number 5. The cyclicals.
Just don't buy in the hope. Wait for things to get better. Prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big.
Companies in this category tend to exhibit inconsistency in revenue growth. This is because their sales and profits rise and fall along with economic trends. For instance, industries like steel and chemicals are cyclical because when the economy is doing well, these companies experience higher demand for their products due to increased construction and manufacturing. However, during economic slowdowns, their sales and profits tend to decrease. While cyclicals may have a predictable pattern, investing in them is much more complicated. The shifts in business cycles aren't always easy to predict accurately, and making incorrect timing decisions can result in significant financial losses. In Lynch's playbook, cyclicals are not a wise investment choice for newcomers or those unfamiliar with these industries. Instead, they are for more experienced investors who understand how these companies operate. Therefore, if you are uncertain, you should seek advice from someone knowledgeable. Number 6. The last category on this list is asset plays.
Companies like Intel and AT&T not only make great products, but they have numerous patents for these great products. As long as they have those patents, no one could make the exact same product. That's a tremendous aid in any business.
Asset plays refer to companies that possess assets that might be undervalued by the market. Simply put, the stock price doesn't fully reflect the value of these assets, and this discrepancy creates a potentially lucrative opportunity for investors like you and me to earn significant profits when the market eventually realizes their true worth. These assets include cash, valuable real estate, underutilized investments, patents, and trademarks. Perfect example is a company holding substantial cash reserves and liquid assets. That cash alone could surpass the entire market value of the company. This means that even if the core business isn't performing well, those undervalued assets act as a safety net, providing stability and a tremendous potential upside for investors. The other example is a tech company with an impressive portfolio of patents waiting to be fully monetized or recognized by the market. Once these patents are licensed or sold, the company's overall value can seriously rise. In dealing with asset plays, Lynch's strategy involves identifying the hidden worth of an asset before the larger market catches on. Once you identify the undervalued asset, you should take position and wait for the market to acknowledge their asset's actual value. This process can take a long time, even years. It might involve additional research to ensure the asset is as valuable as initially estimated. Still, there are risks to this strategy. Sometimes, the market might not acknowledge the value of the undervalued assets, or the company could mishandle them. So while there's a chance for good returns, investing in asset plays needs you to understand the company and willing to wait for the market to recognize what's there. And there you have it. So thank you so much for watching. Like and subscribe, and have a great day.